Every stock market term explained, for beginners. Introduction. Most people avoid the stock market for one simple reason: they do not understand the language. When students hear words like shares, dividends, market capitalization, or P/E ratio, these terms sound difficult and confusing. Because of this confusion, many people stay away from the stock market. But in reality, the stock market is not complicated. It only seems confusing because it is not explained in a proper and simple way. In this lesson, I will explain every important stock market term in clear and plain English, step by step, for absolute beginners. No technical jargon, no confusion. Let us begin. What is the stock market? The stock market is a system where companies raise money and investors invest their money. When a company wants to grow its business, expand operations, or develop new products, it needs capital. Instead of borrowing money, a company can sell small parts of its ownership to the public. These ownership parts are called stocks or shares, and they are bought and sold in the stock market. When you buy a stock, you are not gambling, you are becoming a partial owner of a real company. What is a stock or share? A stock, also known as a share, represents ownership in a company. Even if the ownership portion is small, you still own a part of the business. If the company performs well, increases its profits, and grows over time, the value of your share increases. If the company performs poorly, the value of your share decreases. This leads to a very basic rule that every beginner should remember. When the company grows, the stock price rises. When the company struggles or fails, the stock price falls. What is market price? Market price is the current price at which a stock is being bought and sold in the market. This price changes continuously throughout the day. The main reason for this change is demand and supply. If more investors want to buy a stock than sell it, the price increases. If more investors want to sell a stock than buy it, the price decreases. Market price simply reflects what buyers and sellers agree on at that moment. What is a dividend? A dividend is a portion of a company's profit that is paid to shareholders. Since shareholders are owners, the company may choose to share part of its profit with them. Not all companies pay dividends. Some companies prefer to keep their profits and reinvest them back into the business to grow faster. Other companies pay regular dividends to provide steady income to their investors. Both approaches are valid and depend on the company's long-term strategy. What is market capitalization? Market capitalization helps us understand the true size of a company. It is calculated by multiplying the current stock price by the total number of shares. Market capitalization allows investors to compare companies of different sizes. Large companies are generally more stable and less risky. Smaller companies usually involve higher risk, but they also offer higher growth potential. What is the P/E ratio? The P/E ratio, also known as the price-to-earnings ratio, compares a company's stock price with its earnings. This ratio helps investors evaluate whether a stock is cheap or expensive relative to the company's income. A lower P/E ratio often indicates a cheaper stock. A higher P/E ratio may indicate a more expensive stock. However, the P/E ratio should always be used with context, such as industry type, growth rate, and future expectations. What is a bull market and a bear market? A bull market is a period when stock prices are generally rising and investor confidence is high. A bear market is a period when stock prices are generally falling and fear dominates the market. The stock market naturally moves in cycles. Both bull markets and bear markets are normal and expected over time. What is risk? Risk refers to the possibility of losing money. Every investment carries some level of risk. There is no such thing as a completely risk-free investment. In general, investments that offer higher potential returns also involve higher risk. Successful investing is not about avoiding risk, but about understanding and managing it properly. What is diversification? Diversification means spreading your investment across different stocks and industries instead of putting all your money into one place. By diversifying, you reduce the impact of poor performance from a single investment. This helps protect your overall portfolio and reduces unnecessary risk. What is long-term investing? Long-term investing means buying quality stocks and holding them for many years. It requires patience and discipline. Instead of reacting to short-term price movements, long-term investors focus on the overall growth of the business. Time and patience are among the greatest advantages an investor can have in the stock market. Final message. To conclude this lesson, it is important to understand that the stock market is not gambling. It only appears confusing because it is often explained poorly. Once you understand the basic terms and concepts, the entire system becomes clear. When the system becomes clear, fear is replaced by confidence and knowledge. Call to action. If this video helped you, like it, subscribe, and stay curious about money.